Welcome back. The next ratio we will discuss is receivables turnover and DSO. DSO stands for Days Sales Outstanding. Now receivables turnover is calculated by dividing the revenue with average receivables. Average receivables is receivables at the start of the period and end of the period combined and divided by 2. And the days of sales outstanding or DSO is calculated by dividing the number of days in a period by the receivables turnover. This number DSO represents the elapsed time between sale and cash collection, reflecting how fast company collects cash from the customers. A relatively high receivables turnover might indicate highly efficient credit and collection. Alternatively, it might indicate that the company's credit or collection policies are too stringent, suggesting the possibility of sales being lost to competitors offering more lenient terms. A relatively low receivables turnover raises questions about efficiency of company's credit and collections procedure. Again, one might need to compare these figures with sales growth of the company to come to any conclusion. The next ratio we will discuss is payables turnover and number of days of payables. Number of days of payables reflects the average number of days the company takes to pay its suppliers, and the payables turnover ratio measures how many times per year the company theoretically pays off all its creditors. Payables turnover is given by purchases divided by the average trade payables, while the number of days of payables is given by dividing the number of days in a period by the payables turnover. If purchases are not available to calculate payables turnover, then one can use costs of goods sold plus ending inventory minus beginning inventory, essentially this formula, as a proxy for purchases. Sometimes cost of goods sold can directly be used as an approximation for purchases. A high payable turnover or a low number of days of payables relative to industry may indicate that the company is not making full use of available credit facilities. Alternatively, it may be getting a discount on early payment. An excessively low payable turnover may indicate trouble making payments on time, or it may indicate exploitation of lenient supplier terms. This is where one would need to look at other ratios to get the exact reason for low turnover. If liquidity ratios indicate that the company has sufficient cash and other short-term assets to pay the obligation, and if still the payment turnover is high, it is likely that the supplier is lenient on credit and collection. Now in the next video, we are going to look at part 3 of the activity ratios.